Hey guys, in this video, we're going to talk about the bad bear spread. Now, it sounds like something I just made up, and that's because, well, it kind of is. There's really not a technical name for this. It is a risk reversal strategy, but instead of putting just having a short put on this strategy, what we're doing is we're putting a long put not out of the money, but we're putting it in the money. So basically, on the put side, you have a debit spread. The call side, you have a bear call spread. And the goal is to have the stock price go down, and you're bearish on both sides. Okay. So what we like to do when we like to set this up is keep it right around 50 delta. For this example, I'll be in the April or the Apple July 16 monthlies. And what we'll do is we'll go ahead and we'll just kind of place each spread separately, just kind of see where we're at, and then we're going to combine them. So it is a bear call spread. And usually you'd want to place these out at like kind of out of the money. But for right now, we'll put it right next to the strike that's closest to in the money right now, which is going to be a 38 delta. And we're going to sell this 130 strike, and we're going to go ahead and purchase the 135 call here. So obviously this is a bearish to neutral strategy. We're collecting right around 120 bucks for this strategy. And our theta is obviously positive because we are selling something. So now on the other side, what we're going to do is we're going to place a put debit spread. So we'll go ahead and we'll purchase this 125 put right here. Obviously negative theta, negative delta. We're paying around $2 for this. We can make that cheaper and kind of protect ourselves by selling and further out of the money put at this 120. We'll go ahead and sell that. And now all of a sudden our max loss only goes down to 116. So it's cheaper. Our theta gets closer to zero, but it's still a little bit negative. And our max profit obviously went from infinity to now it's capped to the width of our strikes minus the credit that we're paying for this spread. So what we'll do to put on this full strategy, obviously you can do either or, right? You can just play the put side here on a debit. You can play the call side and get collect some theta. But if you can combine them together, which is what we like to do, you can actually save a little bit of money doing so while still participating in that downward move, and your theta will actually also be a little bit positive, and it'll grow more and more positive as time gets closer to this expiration here. So what we're going to go ahead and do is we'll go back and we'll place that call spread on, sell this 130, purchase the 135, and you can see now that our max loss obviously grew to 496 from where it was from that put strategy, and our max profit went up. But here's the thing though, we are only paying for, actually no, we are receiving a 4 cent credit for this strategy. So we are really paying nothing for this strategy when we're collecting 4 cents. All right. So what we need to do for us to realize profit here is obviously we need to stay below this 130 right here. So anything below 130, we will realize a small profit, but we're going to realize our max profit here if Apple goes all the way down and stays below 120. All right. Now, where will we realize a loss? Well, it's going to be above 135. Well, actually, it's above this 130.04 right here because that's going to be where our break even is. But anything above this 135, we will realize our max loss, and that's going to be 496. So really, what we're doing here is we're risking one to make one. It's just kind of basically our max profit is 500, max loss is 500, but we have a little bit of leeway in here in between. So unless Apple just rips up and takes off, on a $10 move, you can see it's only expected around $5 here. If it just rips up and takes off on a $5 expected move, then we'll realize that max loss. But if we still believe that, if we're going by our assumption, we still believe that Apple will go down and it'll rip down this expected move, then obviously we will have a chance of realizing this max profit here. And what we did is obviously we're receiving a little bit of credit, but our theta is positive. Okay. So the closer we get to expiration, the more our theta will slowly increase. And that's kind of what we want rather than just putting on this debit put spread here where we have theta going against us and then hoping Apple goes down. Well, now we gave ourselves a little bit of leeway. We have up until 130. It gives us kind of a $3 window up here on Apple. We have until 130, and we can actually start realizing a loss above the 130s, right? So we have until 130, and then it can go back down a little bit more leeway. Whereas this put strategy, if it goes up to 130, then already we're losing money. Okay. So yeah, that's just a bad bear strategy. It's a risk reversal play. don't really have an actual name for it, but that's just something that you guys can kind of play around with. It is a four-legged strategy. All it is just a bear call spread and then a put spread on the other side. I like to keep them kind of together because you don't really want to go far out on these puts. Obviously, you will collect more, but you're going to have a further away, or you're going to have a longer strike away for the stock to hit for you to start making that, realize that max profit. So if you kind of keep them closer together, closer to in the money, then you will have a chance of realizing your max profit in here closer or quicker, that is. So yeah, there it is. That's the bad bear strategy. Okay, guys, thanks for watching. Make sure to check us out on social media. We have attached the links to our socials in the description, and we also have a swing trading service if you're interested. There's more information in the description below.